How private market returns are really made. Multiples, time horizons, exit mechanics, and risk adjustments. In private markets, returns don't behave the same way they do in public markets. There's no daily liquidity price. There's no real-time bid or ask. There's no public valuation every minute. Instead, private returns are a function of entry price, exit price, time horizon, capital structure, preferences, dilution, growth versus margin expansion, and exit framework. Today we're going to break down exactly how returns are created and measured in private markets. This is critical for investors, advisors, and organizations evaluating long-term opportunities. Private returns start with entry price. The entry price, the price you pay for securities, is the first determinant of return. That price is a function of valuation, dilution, and investor terms. A deal priced at a lower valuation relative to future performance would generate higher returns. This is why valuation discipline matters. Private investors often use terms that protect downside: liquidation preferences, anti-dilution provisions, redemption rights, and warrants. These terms affect the effective entry price. Think of return as exit value minus entry value divided by entry value. But in private markets, effective entry value includes structural protections, so that formula becomes more complex. Return is realized at exit. In private markets, returns are usually realized, not marked. Unlike public shares that are valued daily, private shares are valued at discrete events: secondary sales, acquisitions, IPO, tender offer, or dividend recap. Returns are crystallized at those events, not before. That's why exit strategy matters more in private markets than in public markets. A company can grow revenue for years but deliver zero return if there's no exit path. Time horizon matters. Private investors must think in terms of multi-year horizons. Early stage, 5 to 10 years. Growth stage, 3 to 7 years. Pre-IPO, 2 to 5 years. Longer horizons increase risk but also provide time for compounding. Investors price that time risk through higher discount rates. This is different from public markets where liquidity compresses time risk. Multiples versus cash flows. Private returns are measured in multiples, not daily price moves. A 3x return means an investor got 3 times their money back. But how do multiples form? There are 2 mechanisms. Number 1, earnings growth. Increasing EBITDA expands the base value. Number 2, multiple expansion. Valuation multiples increase because the company's risk profile decreases or its market improves. For example, a company trading at 4x EBITDA that scales and stabilizes may trade at 6x. Multiply that shift by EBITDA growth and returns compound. Risk adjustment in private markets. Private investors price risk differently from public investors. Standard models include discounted cash flow, internal rate of return, multiple on invested capital, probability-weighted scenarios. DCF is used for cash flow-based returns. IRR measures time value of money. MOIC looks at total return irrespective of time. Sophisticated investors often present both IRR and MOIC to evaluate risk-time trade-offs. The importance of exit multiples. Exit multiples like enterprise value or EBITDA or revenue multiples drive private returns. If a business enters at a 4x EBITDA and exits at an 8x EBITDA, that multiple expansion dramatically increases investor returns. This is why operational improvement, not just revenue growth, matters. A company can grow quickly, but if margins compress or risk remains high, multiples can stagnate. Secondary sales and partial liquidity events. Not all returns come at full exit. Secondary sales, which are private transactions where existing investors sell shares, can generate partial returns before final exit. Some investors use these to de-risk or recycle capital. Secondary markets are less liquid than public markets, but they provide optionality. Risk adjustment, the real return mechanism. Investors adjust expected returns based on market risk, liquidity risk, operational risk, governance risk, capital structure risk, sector risk, competitive risk, and regulatory risk. This is why the same nominal return can be worth very different real returns based on risk. Investors require higher return expectations where liquidity is limited. Private markets compensate for liquidity with higher multiples over time. The key takeaway: private market returns are not about daily price moves. They're about entry price, exit price, time horizon, structural protections, and disciplined business execution. Understanding how returns actually are made using multiples, exit frameworks, and risk adjustments is essential for informed private investing.